Hi, welcome to this video series where I answer questions from the readers of Monevator.com. Monevator is the leading UK website for personal finance related issues. The question in this video comes from Dave, who asks if central bank interest rates go negative, what implication will that have for the 60-40 portfolio? Well, first of all, the 60-40 portfolio refers to 60% equity, 40% bond. So sometimes you'll switch it around for some reason. Basically, for $100, pound, euros, whatever, you have 60 in equities, 40s in bonds in your portfolio. The idea is that this is a reasonable level of risk for a lot of investors. It has upside in equities, but also the 40% bond allocation temper the risk. My view is that it's great to keep things simple, but risk is really quite an individual thing and depends on the stage of your life, your non-investment assets, and the correlation of these, and simply how you feel about risk, your job, and so forth. So 60-40 might suit, but don't assume it's for everyone. If you're interested, there are product providers like Vanguard and others that provide a tool or a product where you get automatically this allocation. But back to the question. The answer to the question, unfortunately, it's not really clear. If you assume that the government, the risk of the government is fixed, which is a big assumption, and that the equity risk premiums doesn't change as a result of interest rate changes, then it's clear your investment expected investment return will be lower as a result of lower interest rate. So what does that mean in practical terms? It means, well, basically you expect to have lower investment income in the future if you keep the 60-40 investment portfolio. For those looking to retire, it means that you'll either have to save more, consume less, or work longer to achieve the same retirement, which is obviously not great. Of course, you can change your portfolio composition from 60-40 and invest more in equities, but all else equal, this will be a higher risk portfolio, and you've got to make sure that you have the risk tolerance to do that. But in reality, it's not that simple. Central banks set interest rate in response to the status and the prospect of the economy. It's a great tool to get the economy going. The decisions on interest rate filter through to bond yields for investors, and obviously with lower interest rate, there's an incentive to borrow more money and invest in the economy. So can you assume that government risk is a constant? You can't really assume that. You also can't assume that the equity risk premium is a constant. It's also not really knowable. Equity risk premium is generally deemed to be 4 to 5% above inflation, but it really changes dramatically with changing in the risk of the equity markets. And it's also perhaps not a terrible assumption to say that in a lower interest rate environment where the government's actively trying to boost the economy, that the equity risk premium goes up, maybe at a cost of higher volatility. It's not clear. By the way, one thing I should mention is that all we're discussing here are real interest rates, so after inflation. So if you have a high inflation country of, say, 10% nominal interest rate and 9.5% inflation, that still means that the real interest rate is only 0.5%. So there's no free lunch there. But I would also say, going back to the 60-40 portfolio, that is in a sense a bit of an active choice. This video is shot in June 2020 in the middle of the coronavirus. And one thing that's been very clear is that the risk of the equity market, so the expected future volatility of the equity market, has varied dramatically and shot up massively. So if you've kept the 60-40 portfolio, well, the overall risk of that portfolio has changed a lot. So in a sense, it is quite a bit of an active choice to simply say, I want to keep 60-40. So just be sure you can stomach that. And of course, with higher volatility, it's not unreasonable to expect higher future return, but at the cost of the higher risk. Now, I'd also say that the answer to this question would be clearer if you had 100% bond portfolio and you were receiving lower yields to maturity or lower interest rates. In that case, it's pretty clear there's no potential compensating factor from equities, and you would simply earn less, have lower real returns for your portfolio, and you would have to adjust for that, or simply live with that fact. So in summary, I'm sorry the answer isn't that clear, but I still hope my commentary was somewhat useful. My name is Lars Kroijer. I'm a former hedge fund manager who's written a couple of books about finance, and I'm now doing these videos as a hobby. The premise behind a lot of my work revolves around how incredibly hard it is, in my view, for most investors to outperform the financial markets. In my books and other videos, I explain what this means, and also why I think it's an incredibly powerful and valuable premise to come to understand and embrace. But in any case, I hope you found this video useful, and that I'll see you back here on the channel at some point in the future. Thanks a lot.